Hey everyone, welcome back to Fiscal Voyage. I'm Felix. In today's video, we're going to talk about a stock that on my last video I bought shares of, and after earnings it dropped 13%, 12% after earnings because of higher cost and slightly lower profit. And I want to go over that in this video and discuss why I think I'm going to buy more shares of this company. So the company I'm talking about is UPS, and first off, we're going to look at the fast graph for UPS. Historically, you can see it has some down years in the past. I go more in depth in the previous video. And if we see here, you can see from 2022 to 2024, what analysts are expecting, it has some rough few years of, and this has to do with, higher interest rates, higher cost of labors, and things of that nature. Obviously with COVID, everyone was home, so a lot of people were ordering things online. So that's why earnings just jumped tremendously, in 2020, 2021, and 2022. But you can see here, analysts are expecting still the company to continue to grow earnings. You can see here in 2025, 23% growth in earnings. And this is going to be more because these to me, these few years, the past few years has been very, crazy. A lot of, change in markets and stuff like that, because you can see here how it's like a normal years, from 2010 to 2019, it's consistent, 3%, 4%, a good year here, 14%, consistent growth in the company earnings. So these rapid change is kind of what's happened the past few years. So now what I think is going to happen is going to stabilize. The cost for the company is going to stabilize. Obviously it's going to grow, increase, but much more slightly because they have, union, and truck drivers are getting paid, much substantially higher. But all that is going to stabilize. And, with the world going more and more and more online, and you have South America, Mexico and Central America, all these people are, are going to continue to grow, right? And they're going to have disposable income and, order things online. So those are tremendous growth opportunity for companies like UPS, which are worldwide companies. So this is why I'm, going to buy more shares. You can see here the company is an A-rated credit company. Right now it has a yield of 5%, which is outstanding. Earnings yield of 6.35. So if we put in the price on the chart, and then showing this time period, you can see here for the past few years, since 2016, earnings has been growing around 6%, and analysts are forecasting the company to grow, you see here around 12%, long-term growth around 4%. And you can see here long-term growth, you could get nice 9.5%, 10%, maybe 11% return on your investment, but also, it's a credit rating company with a 5% yield, which I like a lot. And normal PE, if we shorten this, I like to use the lowest PE. You can see here in the next years, by 2025, you get 14.7% annual rate of return. If we were to revert back to a multiple of 15.6, which is, basically on the low end on the history of the company. And you can see here you go almost 15% in annual rate of return. Once this year, earnings and all the things adjust, you can see it could grow, substantially in the next few years, double digit in 2025 and 2026, double digit return. And another thing, right quick, we're gonna go through Morningstar. You can see here Morningstar has it undervalued, 4-star with a fair price of 150. Okay. That's real good. I like that. It's undervalued. 4-star, 5 stars is what I like to look at. And CFRA gives it a 3-star hold rating, but this hasn't been updated. So it's probably a 4-star now, because you see here the price is at 145. And right now, UPS is trading at like around 127. And the price target at 140. And you can see here they projected a 11% annual rate of return. That's that double, or earnings growth. That's that double digit I was talking about for the next few years. And if we go to the fair price, they have a fair price of 137. So right now it's at 127. So it's undervalued also based on CFRA and Morningstar. But the main thing I want to look at here is the chart. And you can see here the 3-month closing price for UPS is right at the 50 moving average for the 3-month close. So you can see here that each bar is 3 months, and you can see it's right at this 3-month. You know, obviously it go a little lower, it go up to like 120, but this is a great area. If we do this here, you can see here, right here is support. This was resistance. It did a peekaboo and then crashed down. And obviously this is COVID right here, where it went to the 50 moving average on the 3-month, and it did a peekaboo here. And then this, it was resistant. 120 was a strong resistance. Then it eventually broke out. And then now it's right at that 120. So this is a long-term, what is called a buy setup. You had the consolidations here. You had a breakout. Now it's returning back to the consolidation to eventually the support. Resistance now turned to support. Now we have a buy setup. You know, if those of you guys who knows technical analysis, you know exactly what I'm talking about with a buy setup. We had a 50% retracement from this move, 50%. So now the great opportunity to buy. Now obviously it could pick a bull here, it could stay here for a little bit, and then eventually run up, as you know, because this is 3-month price. So it could go lower, you know, up to 120, 110. But these are all great buying opportunity to buy more shares of UPS, and it's a beautiful long-term buy setup. So now we just buy shares, take that 5% yield, and not only 5%, but it grows annually. And I'll show you, they're also going to continue doing share $500 million worth of share or target of share buybacks. So earnings is going to grow that way as well. So this is why I like this. I want to buy more shares because of this right here. This is beautiful 3-month buy setup, long term, to take this stock back higher to the $230 range. As years. This is going to take years because this is a 3-month chart. So it'll take years before it could get back there, but we're long-term investors. Now, if we shorten this to the monthly chart, you can see here, monthly chart, it shows like it go up to 110 right here to the 200 moving average. You can see here how it bounced right on the 200 moving average during COVID. So it's possibly, this is why I say it could go lower, it could go up to 110, but this is definitely where you want to go all in, around the 110 to $100. At that point, I think it probably yield almost 6%. And that'll be outstanding on an A plus or A credit rating company. But again, this is right here is all the support. Right here is all support area. This is why I like this. This is all resistance, and now we're expected to become support. So that's why I want to buy more shares on Friday once I get paid. Buy more shares. It's 5 yielding company, and you saw back in fast graph. If we go back to it, earnings are continuing to expected to grow. Is the dividend safe? If we look at operating cash flow, the dividend is safe and covered on operating cash flow. Free cash flow actually, barely covers the dividend, but is expected to grow and continue to cover the dividend. So that's real good there. And what I want to show you here, this guy, Dividend Sensei, made a nice article on UPS on July 22nd, which is a few days before earnings. But it just, you guys should go over this this analysis. And I agree, very low risk, 5 yield, 5% yield, which I like a lot. And it talks about, the growth of the company, projected growth, Asia diversification. Once, a lot of these people live in poverty, but they become more and more access to more money, disposable money, they're going to be ordering online as well. So there's a whole untapped area of possible growth. So he covers all this stuff in this article here. It's the latest article on Sinking Alpha on UPS. So that's one thing, I like about this company. And if we go back to fast graph, you can see here, they are going to have a down year compared to 2023, but it's still positive. $7.58 in earnings. It still covers the $6.52 in dividends. And you can see here, analysts are still expecting the dividend to grow in the next few years. And I see no reason why that wouldn't happen. But my favorite thing, again, is back to the chart. If we look at the 3-month, this is a beautiful buy setup right into support here around the 120 area, 120, 130 area, right into the 50 moving average, on the 3-month time frame. So that's the reason why I'm going to buy more shares of this company, and this great 5% dividend yield and earnings yields looking good. So thank you for watching. Make sure to hit that like button if you enjoyed this video, and if you're new to the channel, make sure to hit that subscribe button, and I'll see you guys on the next one.